Major funding for these broadcasts has been provided by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank. Additional funding has been provided by AmTrust Title Insurance Company, AVR Realty Company, Bank of America, Merrill Lynch, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, JP Morgan Chase, Citizens Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Marinkoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
Money. People need money for real estate. So who's providing it? Is it the banks? Is it the insurance companies? No, it's this group of individuals and entities called private equity funds, alternative lenders. They're the money today, and they're giving it. So today I've assembled this group of leaders and financial experts to talk about where the money is, what alternative lenders are doing. My guests today include Josh Zegen, who is the co-founder and co-managing director at Madison Realty Capital. Robyn Sorid, who is the co-founder and also co-managing director at G4 Capital Partners. Peter Sotoloff, who was also a co-founder and the chief investment officer, managing director at Mack Real Estate Capital Strategies. And last but not least, coming in from Boca Raton, Florida, our friend Tony Fineman, who is the managing director for East Coast Originations at ACORE Capital. So, in all the years that you've been in this business, has it been this competitive?
There's been times when it's been this competitive, but I would say that it's an extremely competitive time right now.
Why? Is it the banks? Is it your fellow compatriots sitting over here?
It's these three people right here. No, I mean, everyone knows there's a ton of capital in our space today, and I think there's plenty of deals, but there's just a lot of capital chasing those deals. So.
Now, Josh had said in the green room that the capital is out there because the equities are not being used. What were you trying to say about that?
Well, I was just saying that the equity markets have been, really not much going on the equity side of the business. And part of that's because transaction volume is down because there's been so many debt funds. And a number of debt funds are just, people are looking to, instead of selling their property, refi out some equity, recapture some of the equity, and hold longer rather than sell into a market that's so-so, at least in the New York market. And we're seeing that in some other parts of the market as well.
But when you hear somebody looking to take more capital out, it reminds me of the 2006, 2007, that when people take too much money out, sometimes they really aren't. They don't look at their properties as well.
Look, I having lived through a number of crises, including the most recent one 10 years ago, I think I'm going to draw some clear contrasts. I do believe there are a proliferance of new debt entrance to the debt market. Typically happens when those parties can't find equity deals that make sense. and they viewed it as a safer option. But what I would also say is, unlike the prior crisis, when you had a mispricing of risk, over-lending, mismatching of your assets and liabilities, the excesses that we saw in that part of the financial crisis are not here today. I would say that what has happened is you're seeing basically a race to the bottom in spreads, but you can't broad brush that in the market with all types of lending. For construction, heavy transitional to moderate transitional versus light transitional, there's still a very wide range of pricing. Yes, it's in 50 to 100 basis points year over year, but I think you have to draw distinctions between what's perceived as the degree of difficulty in the business plan execution underlying your loan collateral.
Are we seeing more families go in? As I was saying a couple shows ago, the 4 families, the 5 families that were the major New York families, are we seeing families saying that they should get more involved with this? We know that the Fisher brothers are involved with it over there. That RFR.
I think it's kind of because of what Josh said. I think you're seeing a lot of entrance into the market at what I think is deeper in the capital stack than guys like us will go, because they are having a very hard time finding equity deals that they like, that they think are going to get a return on, and they have all this, they're sitting on a bunch of cash. And so they're looking and saying, maybe I'll lend 85, 90%, maybe I can get 12, 13, 14% of my money for a couple years while I can't find equity deals to place.
But to Tony's point, though, I think what we're saying, we see a lot of family offices sitting on a lot of liquidity saying, can we participate in a lending deal? Can we take the last out piece? And I think people are looking for yield right now, and they'll be opportunistic and somewhat agnostic. To your point, Peter, in terms of the New York market, I think the New York market is different than what we're seeing nationally. In the New York market, because of the influx of capital, deals are getting picked over. It's a race to the bottom, both in terms of pricing and sponsors. At least some sponsors that shouldn't be getting deals done still are. I don't think any of us are financing those sponsors, but you'll see sponsors who have 2% of their own capital in, are really doing a large raise and are doing $100 to $200 million projects. And with a good book, they have at least a chance of getting capital just because there's so much capital coming into the market. And that's what we think is the scariest part, and is the only, I think, hangover from the prior credit crisis, where we saw very little check on what values were.
A couple of years ago, I did a show, and I had somebody from the Carlyle Group saying that he always joint ventures with somebody, that he prefers to deal with alternative lenders because it's easier in case sometimes, you don't have all the documentation needed at closing. You're easier to deal with, facilitating.
The implication there is that we are cutting corners to be easier. And to me, what it is that regulated banks and financial institutions can't always make risk decisions to look past something because they're stuck to a standard.
No, I think the comment the guy from Carlisle said was that I have to give the same documentation, but I don't always need everything at closing. There's more tolerance level.
There's tolerance if you think that you're not taking a risk by not getting it, right?
So I think what's happened is, because the industry grew so much over many years, there's different shades of the alternative lending universe. So you have some, and we're more focused on special situations or construction or heavy value add. There's some that are light transitional that'll use a CLO facility to put things in. And then really that box is, it's not like a bank, but it's a little bit more open. So it really depends on how the debt funds are leveraging their loans also, because a lot of that documentation and structure is around the leverage.
But I also think that the point is that you can make a decision to take a risk that a bank may not be able to take to close, right?
True.
And the decision you're making is not to waive something that you think is important. It's to say, look, I understand the risk.
I wasn't talking about waiving. I was talking more about
accepting later.
We do have flexibility. I think Josh and I share a lot of borrowers, and they'll say, well, there's always a surprise that we need, at least first-time borrowers, the level of documentation. And I think that's just a misconception about what private capital is. For us, we really want the same documentation. We just want to be more nimble, more able to assess the asset as opposed to just the asset class without in detail. But I think because we're backing up to secondary financing, we have some window, but we do need the same deliverables as a bank would need ultimately. It's just the manner of getting it. We're also help the borrower. We don't just give them a list and say, we need this list by X date. Sometimes we'll actually sit with them, help them create their underwriting, help them create all the financial, not create the financials, but provide the
No, no, but
financials.
part
Called
because-
lender liability.
Yeah.
No, but part of that situation is necessity because you're leveraging the loan. You
We're
want to be
leveraging
able,
the
you're
loan.
leveraging, you're taking it to another institution who wants to make sure that you have the correct documentation because they're making.
But we
money
also
on
don't
that.
have the luxury of just having borrowers who have a package ready to go. I think if we only target a group of borrowers who have an institutional package but want private capital, you're going to really limit
here's
that.
a question, okay? Somebody's coming to you, they work for a company for a couple of years, they leave the company, they want to go out and start their own business. How do you make your determination that you like that person and you're going to bet on that horse?
The answer is we don't. We're very specific on who we're doing business with. We're institutionally capitalized. We're not looking to, there's only downside in lending. Other business plans have that type of mentality where they may be more flexible in that regard, but we stick with people that are known in proven quantities with assets. But the other thing is for lending shops like all of us, it starts with the real estate. And is this an asset that if times get troubled, if there is a dislocation or some type of correction, would we, God forbid, want to work through those issues at that basis, perhaps up to and including foreclosing and executing the borrowers or another business plan? And that's as simple and as basic as it gets. Otherwise, we're not making the loan.
I think if you're not happy with the asset going in, then you shouldn't do the loan. We're not an opportunistic lender where our goal is to take back the property, but our documents are set up. Everything is set up that if the world changes or if our sponsor fails, we'll take back that asset. But just to go back to the prior point, we do take chances on new sponsors, but we won't take chances in a vacuum. So if we have a sponsor who doesn't have that development expertise, we'll help pair them with a GC who we know has the experience to execute on the business plan, or other consultants. And so sometimes we'll see a new sponsor. It's always asset driven, as long as we like the real estate, but we'll make sure if that specific sponsor doesn't have the experience that we'll at least bring a team to them so that they can execute on their vision.
You know, when we're talking about asset-driven today, we have a variety of assets, which we were talking a little bit in the green room. One of them is the category that people are saying is the death asset today, retail, which I don't believe is death asset. I think it's retail in specific markets may be hurting in specific streets. If you take retail in the outer boroughs, the retail is very strong about the outer boroughs.
I think retail's been painted with an exceptionally negative brush, and we, frankly, and you're gonna see this as a dichotomy, we have no retail exposure in our lending book, but I do believe, and our business is not to take undue risk with our conservative investor profile, but the idea is I think great fortunes are going to be made working through, and already are, through the weeding out of subpar retail, repurposing and redevelopment of that. But as far as the lending business we run, we will have some retail as part of a mixed use. For example, you mentioned Witkoff. We put together the $765 million construction loan on 20 Times Square. The NFL experience and the Hershey
and
chocolate
Hershey's
company,
made the retail without any
yeah,
problem.
so we'll take specific risks in the context of a larger project, but we've had for a very long time very negative views and very negative, even before it was water cooler talk, on the retail, and that is expressed in our positions from credit perspectives. Not to say that great fortunes won't be made figuring out other alternatives in the equity side of the business to repurposing retail.
But there's a lot of it out there. So I agree, great fortunes will be made, and there's some people that think they're going to make great fortunes that may not be able to, because there's a lot of square footage
I
out
mean,
there
there are a lot of suburban retail strip shopping centers out there, and when, one of these tenants moves out, or Carter's is in trouble, or Men's Warehouse is in trouble, and you see, Toys R Us, the lead moves out of the property, some of the deals change over there, and then you got to bet your horse. You could be happy betting your horse on Target. You're not going to be happy betting your horse on Sears today. It depends on the type of property. Another area, another asset which is highly volatile is the hospitality industry. You have a large portion. You have some hospitality, and I believe you do.
And we're doing hospitality as well.
That's right. You've done hospitality in the boroughs.
We've done hospitality in the boroughs, but in very developed markets. And we've done hospitality that are unflagged. So we exited a position in Williamsburg, which was a successful exit. That's harder. And I think we're always looking for the new opportunity. There's a lack of capital right now coming into hospitality, especially hospitality construction financing. So we're very careful on who the sponsorship is, but we're certainly looking at it.
I mean, because the hospitality is being really affected by the Airbnb because you're taking such a large number. In certain
I would say it's more than that. If you're speaking about the tri-state area in New York in particular, you've had 16,000 new rooms enter the past few years. I think we're doing a good job of absorbing those, but that's affected, and we've been very cautious.
Right, but
on
you
our
also
hotel.
you also had
affected
60,
and I think-
you had
ADR.
62 million visitors come.
I
over last
agree
year.
wholeheartedly
So the
with
62
that,
million visitors, there's a need for that. Okay.
But oddly enough, like as Peter was alluding to, it's the absorption is fairly effective from an occupancy standpoint, but rate is being compressed.
The rate is
by the factors
By
you
the
mentioned,
yeah.
Airbnb, other hotels that need to stabilize,
Right.
et cetera, et cetera.
And we're very careful with hospitality assets, which have a large percentage of their revenue coming from the F&B, because we're not in the food and beverage industry, and we've seen some interesting projects, but a disproportionate amount of their projections are coming from revenue, which we really can't model.
Right, and when you're in food and beverage, you're in the restaurant business.
You're in the restaurant
okay,
business,
in a
which is its
restaurant
own-
business with a 50% failure rate.
Well, I
it's gonna
thought that
change.
you also have to, I think, I mean, a lot of projects that come to you today, that's how sponsors are making their numbers. They're projecting F&B revenue, but
the word is project.
But no,
Remember
I understand what I'm.
projection.
But my point is, you do have to be very cautious when you look at things like that. But we're in the process of closing. I think, just out of the East Coast, we're closing 3 hotel loans right now. So, I mean, you have to pick and choose. And you have to be careful about basis. You definitely have to make sure that you're dealing with the right sponsor.
There's a misconception about condos. And if you want to really talk about the condos, even if you take into consideration Gary Barnett's new property in downtown Brooklyn, it's doing rather well because it has a 25-year tax abatement. So that's one of the big benefits. So you're not affected by the tax law. That's one. Also, there's a lot of rental apartments in downtown Brooklyn, and there are very few condos. So, you're looking at that type of asset. How do you look at the condo market today?
I mean, it's very basis driven. It's, there's a lack of liquidity around construction-related financing in condos. One of the things we've been able to do is provide sort of a whole loan to developers today, where we provide the senior and mezz. That's been a big opportunity because a lot of lenders are trying to piece it together between a senior and a mezz, and it creates a lot of complexity, uncertainty, cost. So we've been able to do a number of deals that fit that profile recently.
You have to be, and again, this speaks to our portfolio, we have a fair amount of construction, about 30% of our book. We are one-stop shop, as Josh was alluding to, in terms of being able to provide the holistic solution. Our average condominium loan is in excess of $200 million and far greater. But what I would say is that basis in this market is everything. We like the more commoditized products, if you can call them that, versus the ultra wealthy type products that I think will have a number of touch points of distress as the cycle matures and where there's cost overruns, they can't make their sales. And so we've largely avoided that, just given the chunk pricing of that, where we can look at a downside as in often cases, not all, as primarily as a rental fallback if that needs to happen. And also we're dealing with very, I would say, institutional borrowers where they have development experience, they can manage the cost overruns, they have the liquidity to do so, but also they will agree to milestones where if we need to, despite their equity objectives, return on equity objectives, if we need to move product to right size the loan at lower than ideal prices, we can force that discussion to protect our loan.
We've used those levers as well. I think you have a lender basis driven view, and then you look at your sponsor's basis, and sometimes the lender basis is great, but the sponsor ultimately will fail, and you have a choice of either going forward and seeing if the sponsor will prevail, but making sure that you have levers to make sure that they start selling below their basis, or you pass on the project. And some projects we've gone forward in areas where we feel very comfortable, but we have specific levers that they must sell at X%. And we think that's very important. We also are still doing condos, but are price point driven.
I think we do the same thing with respect to how we structure the loans, and we're not adverse to doing condos today. I think it's kind of the same answer with respect to all the product types you just brought. Like, we're all doing hotels, but you have to be careful about where you are and who your sponsor is.
The
same thing with condos.
Okay,
Same thing with
in a similar manner, emerging neighborhoods. Okay, people are saying, we have ferries now. Okay, fine. So we have ferries. So you can have a ferry to Far Rockaway. Okay, but it's still a ferry, and if you're not right near the ferry, you have a train that's going to take you 2 hours to get in because it's a long trip over there.
I think
Like
that
Coney Island
it
opportunity.
depends on what your definition of emerging neighborhoods is, but if it's truly an emerging neighborhood, to us, that's tough. I mean, because you really are speculating.
We're not here to be in other programs. They can make a lot of money and they can be kind of making those sharp shots. We're in markets that are the major MSAs, 24/7 cities where the liquidity seems to want to be, where the demand generally is and returns after a cycle, and you have the sophistication level of the sponsor. We're
But
not looking to be
I'll give you an
pioneers.
emerging neighborhood. The largest city in the state of New Jersey is Newark. Okay, there are certain things taking place in Newark.
Yep.
But the irony is that they just had the topping off ceremony today for this one Rector Street. One Rector Street started in about 7 years ago.
Right.
It's taken them that long to build the first new residential rental building in 50 years or 58 years in Newark.
And now it's
Okay?
emerged.
Okay, so the whole question is, how do you look at certain different markets like Newark, Jersey City, Long Island City, which we were talking about? You have enormous number of hotels, you have enormous number of rental apartment buildings.
So it's interesting that Long Island City is an example where there was tons of rentals but very little condo product, and
Right.
condos actually were moving very well because there was so little product out there. And downtown Brooklyn, no, not downtown Brooklyn, Brooklyn in general was also had a lack of condos relative to rentals. So there's areas like Manhattan may have had a lot of condos in certain markets, but there's pockets of opportunity in the boroughs like Long Island City.
agree.
We were in Long Island City on a large development. There was a lack of condos, and then within 12 months, there were numerous condo projects coming at the same time. And we were in a development loan. I think what happened was construction lenders became much more careful because they were all coming to market at the same time. And the prices were just under Manhattan, and Manhattan started dropping. And I think at that point, the opportunity in Long Island City went back to rental. I've seen a number of projects in Long Island City that are condo development plans, and they just aren't getting financed.
I think you're going to see a lot of pain in taking Long Island City, just given the supply-demand metrics. I think most people, if they had their choice, if people are going to be giving concessions and undercutting pricing, they'd much rather live, in Manhattan. And I think you're just awash in a lot of supply. And I think there'll be pockets of distress, frankly, despite over time. I think given demographics, people will shift, that will be absorbed. But I also think for undercapitalized sponsors that can't afford to make the concessions that need to be made to fill those units, I think you're going to see some distress as the cycle matures.
In a similar manner, how do you see the suburban office market? I mean, and you did a deal recently in Stamford.
It's a very
okay?
good deal.
Good question.
I didn't say about the deal. I'm talking about in general about the suburban office market because, in 30 years, Westchester hadn't seen rent increases in certain parts of New Jersey. If your basis is what you're saying, is fine, but how do you look at it? Because
That's
a lot of people are looking at the basis, and you're also looking at the key today. Transit-oriented development is a very big thing. Anything that's near the train is important. So if it could be repurposed, okay, taking the office building and making it a residential thing, which has happened quite a bit in Westchester, and it was written up this week in the Wall Street Journal, which is a fact, it's changing the market. But if you're taking certain markets far, the office market is a tough one.
You have to be careful, though. If you're doing suburban office, you're not doing a one-off suburban office deal. You have to get very smart on that market. That market moves differently than the New York markets, which we all live and breathe and are on top of. And those are assets that you get hurt very quickly.
Now you operate in Long Island.
That's a different kind
okay,
of suburb.
so how do you look at the Long Island market? Because it's a different bird.
Sure.
Okay? It's a totally different.
So we have an office in Long Island in Roslyn, and that enabled us to do a large townhome development right next to our office, and we were actually watching that market. So when I was speaking about the suburban office, generically doing suburban office across the U.S., those are markets that move not necessarily consistently with the metro market that we're spending time in. In Roslyn, we knew that there was a need for empty nesters and step downs from the city or young couples coming from the city for living that was really urban living that didn't exist before, and that project has been very successful. That was a unique project because we took an equity stake as well, because for us to lend on a project like that would be very challenging because there was nothing else in the market like that. As an equity opportunity, we believed in the thesis, we believed in the sponsor, and the first phase is largely sold out. We wouldn't do that if we were just getting paid as lenders.
From a macro perspective, very negative. If you look at demographic trends, people are moving back into the cities. Millennial workforces want to live and work in the cities. But when you look at micro markets, for example, we just got paid off on a large loan we did in Greensboro on the Silver Line in Northern Virginia. They were in the path of growth. Sponsors a proven execution of leasing it, took it from 28% to over 90% leased. You have government defense spending that's been filling those buildings. Plus, it's within the per diem, if you will, or the per pound that the government agencies can lease at. And it was the, if you will, a very solid building with transit-oriented development characteristics you mentioned with the new Silver Line. That's a textbook where proven sponsor, proven location, can undercut the market given the sponsor's basis. That's a great suburban office story. If you're talking about macro trends, suburban office still hasn't recovered from prior cycle pricing. It's still down relative to the prior cycle.
I was joking with Floridian before, since he commutes on the plane.
Yeah.
The JetBlue, no. All of you have exposure in Florida except for you, Robyn, okay? How do you feel about the Florida market?
I feel the same way I feel about all these markets. I mean, like, as you've been saying, there are sub-markets, there are micro markets, there are deals that make sense. We lend, all of us lend on basis, we lend on sponsor, we lend on cash in the deal, we lend on the business plan. And so I don't think you can you can broad brush certain things for sure, but I think for the most part, we turn down, I mean, we pursue a very small percentage of the deals that we all see. I don't know who's doing the other ones, but we pursue a very small. But my point to you is, when you say how we feel about Florida, we turn down a lot of deals in Florida, but we're doing them, right? So it depends on the specific deal and the specific market. There's parts of Florida that you have to be careful about. I mean, the condo market in Miami is fairly frothy right now, and I think it's hard to find a deal in Miami where the request is at a basis that makes sense.
Yeah, we've been slow
but there's opportunities.
On condominium in Miami. We just got paid off on 2 large projects for Related, but we entered into Boca, but we like as a macro statement, the growth profile, the trajectory, demographically, the new, obviously the tax law promulgates savings for a market like Florida, which we think is very positive. But again, it's project sponsor specific, that really, the real estate location specific that we feel.
And a lot of banks have pulled out of the market. So there is a void, there's an opportunity. And I mean, it's become more of a 24/7 market in terms of a place like Miami, and Fort Lauderdale is actually, seems like there's a lot more momentum there because it's more of a local market, in general.
That's a good point. Like there are sub-markets like Fort Lauderdale that there are very positive trends, but you can also get hurt.
So in general, I'd say that there's money out there, but the key that you were saying, it's basis driven, it's sponsor driven, and it's also risk reward. And it's a good thing that we have the alternative lenders, because that's the major players today in the market today. I'd like to thank Josh, Robyn, Peter, and Tony. See you next week.
Thank you.
Thank you.
Thanks.